Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The International Monetary Fund has revised its growth projection for India for the fiscal year 2024, increasing it by 20 basis points to 6.3%. That means that India is anticipated to maintain its position as the world's fastest growing major economy. This at a time when the fund has questioned the prospects of the Chinese economy, among other concerns that it has raised. Reacting to the IMF announcement, the outlook, Prime Minister Narendra Modi said, and I quote, "Powered by the strength and skills of our people, India is a global bright spot, a powerhouse of growth and innovation. We will continue to strengthen our journey towards a prosperous India, further boosting our reforms trajectory." To discuss this and more, at a time when uncertainty seems to be the only certainty, I am joined by two leading economists, Saugata Bhattacharya, the chief economist at Axis Bank. We are also joined by Indranil, the chief economist at Yes Bank. Thank you very much for joining us today. The IMF outlook, 20 basis points, in some ways a small upward revision, but at a time when we are seeing concerns continue to exist all across the world, inflation, and especially in the United States, what's happening to bond yields. What do you make of the significance of this upward revision? Saugata, I'll start with you first.
So Siddharth, thank you very much for having me on your show once again. I'm very glad that the IMF is actually gradually moving towards the consensus growth estimates now. You know that Reserve Bank of India has been forecasting a 6.5% growth for India's GDP for a long time now. We are also at 6.4%. So it's nice to see that a leading international multilateral organization is also beginning to catch up. I believe the catch-up is largely due to the relatively high Q1, the April to June growth number that actually came in at 7.8, a bit lower than what we had expected, but still very high, despite the base effects of last year. So I think that was the part that drove the IMF to up the numbers. Remember too that the only other large economy which has a significant upgrade is the US. The US economy also remains very strong, but far lower than what it is in India, around 2%. I believe the other factor that must have driven their upward revision in the growth is that our current account deficit, our trade deficit, which was initially projected to be fairly significantly bad, is also improving fast.
Okay. Indranil, that very same question to you, along with the point that Saugata said, and he said it very subtly. IMF is only playing catch up with our own Indian economists.
I'm not sure about Saugata's projection. He just referred to the RBI's projection. Fortunately or unfortunately, we are at a 6.1% and we might not be moving our numbers higher before we see the Q2 numbers. Yes, the 7.8% was a relative surprise to us. But having said that, I think the RBI also clearly makes it a point that the transmission of the monetary policy is still not complete. So as the transmission of the monetary policy continues, along with the fact that there is a likely tightening condition of the liquidity in the domestic economy, which means that lending rates are not going to go down. In fact, there might be a tad upward momentum in the lending rates, given that banking sector challenges of deposit mobilization could be higher and more deposit rates could also be therefore tending to move a tad higher also. So given all these perspectives, the second half of the financial year is likely to be a lot weaker than the first half. And even though the 6.3 number appears to be sort of different from the or higher than the 6.1 that the IMF was carrying, it is still lower than the 6.5% that the RBI would have. And therefore, I think whether it is a 6 or a 6.5%, The critical issue continues in terms of how what is the quality of the growth. And the quality of the growth continues to be the fact that the urban demand is still much more robust than the rural demand. And unless the rural demand catches up, I'm not sure whether only urban demand can lend sustainability to the current growth process.
Okay, and that's a theme that's been prevailing for some time now. Saugata, on the point of quality of growth, do you see rural growth actually improving? We've kind of had a fairly okay monsoon, not too many shocks really. Do you see some prospects of improvement?
So the rural side is presenting a mixed picture. There is no doubt about that. As you know, the FMCG companies are predicting a better second half for the year on the basis of whatever we have seen of crop sowing, crop acreages, etc. The prospects given the rainfall for a relatively normal Rabi season, etc. So that's their projection. But there are signs of stress in the rural areas. I mean, employment in the Narega scheme, the income, guaranteed income work, which is a very low-paying area, still remains very high, which does show rural stress. But I'm beginning to see signs of some improvement, given the surveys from various private sector bodies. There are some. It does seem that companies are increasing their inventories and stocks in the rural distribution centers. So I'm not very pessimistic, but the picture is definitely more mixed. There are signs, as Indranil also said, that the growth rates for the Q1, for Q2, Q3, Q4, the second half are likely to be closer to 6 rather than the very high outlier 7.8%. But that's what brings the number down to 6.3, 6.4, 6.5. So given that, remember from the international front, when the world is growing at 3%, are attempting to grow at a very high 7%, etc., might actually create more macroeconomic problems. The current account deficit will widen, the rupee will begin to weaken, etc. So I think we are in a sweet spot of growing anywhere between, as Indranil says, anywhere between 6 to 6.5% is jolly good show. In this environment, if the global trade environment, I mean, you know how merchandise and services trade has slowed in the first half of this year. So if that had not actually happened, that's the transmission channel from the weak global environment to India. Our growth would have been faster. And this is very creditable, as you mentioned earlier in your show, that the global environment has become extremely volatile. The same conditions that had prevailed in October and November when the Fed had been raising rates, high US Treasury yields, high oil prices, with the very strong dollar have shaped up again. So very adverse international conditions. So despite this, the IMF recognizing a 6.3% growth is very, very credible.
Indranil, let's turn to the United States because Saugata has basically led the discussion there. And the issues that he mentioned, are they manifesting in bond yields? Is that why we have seen what's happening to bond yields? Although I had another voice on the show earlier say that perhaps the worst may be behind and the collapse may not get prolonged beyond what we have already seen.
I think it's quite a quiz now in terms of how the bond yields, especially the long term, is moving. I think, and I believe that one of the very factors that is actually sort of pressing the bond yields relatively on the lower side, and I use the word relatively very carefully here, is the very fact that most of the Fed talk recently has been to point out that they might not be needing further increases in the interest rate. So that's one part of the story. But having said that, I think the long-term bond yields will, to a large extent, also depend on the demand-supply dynamics in the US bond markets. And clearly, I think China and Japan both are bringing down their exposure to the US treasuries. China specifically to meet their own sort of requirements in terms of stabilizing their currency markets, And on on the other side, the supplies in terms of the US treasuries, that has also relatively gone higher. So we don't expect a very sort of a drastic reduction in the bond yields from here on. But I do agree to the belief that we might have peaked. And the fear that was emerging at a certain point in time that the US 10-year yield might actually be touching or breaching a 5% is now much reduced as we speak.
Saugata, what does this mean for India in the medium term?
So, a couple points. I agree with Indranil that US Treasury yields are probably unlikely to reach 5%, although I'm not 100% certain though. Remember, the US's problem, the Federal Reserve's problem, is the very high fiscal deficit in the US. 5.5%, probably going to touch 6% of GDP. Their GDP is $26 trillion. So that's a huge amount of supply of paper that's coming in the markets. Given the fact, as Indranil pointed out, that many of the global central banks are cutting down on their exposures. So the supply-demand balance, till now it's held up. So the supply-demand balance actually favors a rise of US interest rates. The second part is there is with the Fed QT, the quantitative tightening now, they have shed about $1 trillion of their balance sheet over the last 6 or 7 months since the quantitative tightening started. So that means there is a dollar shortage in addition to the imbalance in the US treasuries. So even that is a factor that is pushing up yields in the US. That's another point. And the third point is, although the Federal Reserve is probably peaked, it's not going to increase rates any further. The differential, the expected differential, Europe is in a bad condition. So if any central bank actually cuts rates, it will be the European Central Bank. And markets, as you know, always work on expectations going forward. So there will be a tendency for the dollar to appreciate even further from here, given the fact that the European Central Bank will be expected to cut rates before the Federal Reserve. There are multiple uncertainties. A prospect of a recession, etc., in the US might always come out true. But generally, this is the base scenario that we are working with. So I'm not very sure that we are at the peak. I think there is some ways for both the US treasuries and for the dollar to go up, which has implications for emerging markets. On the other side, we are beginning to hear of more stimulus measures that are coming out of China. Their ability to cut rates is now limited because the Chinese PBOC cannot keep cutting rates while the Fed is high for longer or maybe even increase rates at some point in time. So China's ability is limited, which will have implications for the Chinese currency. The Chinese currency is likely to depreciate, and that will have an impact on their entire emerging market basket of currencies, including India.
Indranil, on that point of China, the numbers that are being spoken about in terms of the size of the stimulus, some people say that even that may not be enough because just one real estate company could have a bigger hole than what's been mentioned now. What's your own reading of the situation as far as China is concerned? Because one of the downstream impacts is commodity prices, and that feeds into the valuations of many companies in India as well.
So I think what Saugata did mention about China is absolutely correct. Having said that, I think China has its own problems, which is slightly different in terms of the fact that they also are sort of getting into a phase of lower consumption due to aging population. So from that perspective, India definitely is once again in a sweet spot and therefore likely to be the center of domestic consumption demand as we go ahead, and that to a certain extent can hold up India's growth vis-a-vis China's. Yes, the Chinese authorities will have a difficult task ahead. Sometimes I also don't believe in the Chinese numbers that come out, because even if Chinese growth is at a 5%, that shouldn't be too bad off, given the size of the Chinese economy any which ways. I also do believe that there is a lot in terms of adjustment that needs to be coming out of the currency markets in China if they want to push their growth through the export dynamics in a situation where the global economy is slowing. So yes, China is a critical element to note in terms of, say, commodity prices. But I think specifically for India, in terms of oil, I think more than China, the supply dynamics, and especially with the recent economic crisis that has broken out, will also be very critical in evaluating the trend of commodity prices globally.
Indranil, since you brought up what's now happening in Gaza, markets and not just the equity markets, but broadly speaking, they seem to have taken this in stride. You know, after Ukraine and before that COVID and now this, I think overall everyone seems to have developed a higher resilience to this. Do you see specifically a broader spillover into crude oil as this conflict worsens?
Well, I think it's very difficult to say at this point in time. And the crude oil will probably get impacted only if Iran directly gets involved into the story, which leads to the closure of the Straits of Hormuz, which is one of the critical channels through which trade moves, and specifically also oil moves into the Asian economies. So if that happens, then obviously crude tends to go a lot higher. And that also reduces the chance possibly of Saudi Arabia to bring down the prices of crude by increasing the supplies. So that's a totally different sort of ballgame that we are talking about. And I don't think that is in anybody's mind at this point in time, though the risk is obviously there.
Saugata, regardless of what happens, the fact is that consumers in India and therefore inflation has been protected by the government absorbing the volatility in oil prices now for quite some time. Even if things were to worsen from a crude oil pricing perspective, would I be right in arguing that as far as inflation is concerned, there will be no pass-through, also because we are now in election season in India?
So a couple of points. I agree with Indranil that this particular conflict in Israel and Gaza is likely to remain relatively localized, fingers crossed. So it will not spill over. However, even without Iran not coming into the war, Iran has been happily producing 3 million barrels per day, exporting 2 million barrels per day. And the US has been turning a relatively blind eye to this sanction breaking. Because with the US negotiating with Iran for various hostage reasons and other things, that is likely probably to stop. That will squeeze an already tight oil market. Secondly, as you would know, that the Saudi Crown Prince is meeting the Russian President today in the afternoon. So that will also decide what kind of further tightening, how long the tightness will remain, etc., over a period of time. In terms of India, so even if the Indian crude oil basket actually goes up a little bit, they might not have a direct impact on the pump prices of diesel, petrol, etc. You're completely right. There are political compulsions to hold prices. But that does not mean that it will not pass through into other input commodity prices. So the ATF prices, as you would have seen, ATF prices have already gone up significantly. On top of that, fertilizer prices, because ammonia is a feedstock and that is linked to crude. So fertilizer prices globally has gone up and will further go up if oil prices go up. There are other components of oil, all the other lubricants and other derivatives of oil, which are decontrolled, which will also feed in. So this is going to have an impact on inflation, on the secondary inflation, tertiary inflation, etc. More worrying is with the onset of the El Nino, global agri-commodity prices have gone up significantly. As we believe that China has probably bottomed out and will probably creep up, its growth will creep up over a period of time, that will have a significant impact on metals prices. Aluminum prices have already gone up 10% since August. So there are multiple risks that I see, and risks that are on the upside to domestic inflation. Although, I mean, the government has shown that using its food stocks, other supply side measures, etc., it has done its bit to keep prices controlled. But my own sense is the global environment now poses an upside threat to inflation, not just to India, but also to the US and other developed markets.
Indranil, the scenario and the facts that Saugata is sketching out for our viewers, would you want to add to that in terms of the inflation mix again seeming to become worrisome?
Well, I think Saugata has very clearly aired his concerns about the inflation and how it can pass on in terms of the second round inflationary effects of the higher oil prices. Having said that, I also see a risk in terms of the external dynamics and also in terms of the fiscal. For example, Saugata did allude to the point of fertilizer prices globally being on the higher side. And I think that's critically a concern because the expected drop in the crude oil prices anyways did not happen. It went to around say a 70 to $75 a barrel and then sort of started moving higher. While the fertilizer subsidies that the budget has considered is significantly on the lower side. So that's a critical risk that we have, which is about say a 50,000 crores. And that to a certain extent would neutralize the advantage that the fiscal had because of the higher dividend pass through from the Reserve Bank of India. Given that we are in an election year and given the volatility in the equity markets, there could be concerns in terms of how the disinvestments would move. And along with that, the moment you say that the pump prices will not be increased, that will have to be absorbed by the government in terms of higher subsidies on the oil sector also. So all that taken together, there can be some risks to the fiscal. And in a situation when we are getting incorporated into the bond index, I think these are certain factors that we need to keep very well in mind because the bond inflows will probably not happen to the extent that we are anticipating unless there is a very stable and improving macroeconomic scenario that the government is able to position. On the current account side, most of us are calculating current account to be in the range of 1.3 to 1.4%, definitely better than the last year. But if oil looks towards a 90 or a 95 as an average for the third and the fourth quarter of the financial year, given the fact that we have not really seen very significant reduction in the non-oil, non-gold imports, while the rest of the world slows down, and that could have its implication on the exports basket for India, along with all the geopolitical worries that are happening in the Middle East. So that would, to a certain extent, can potentially push up the current account deficit higher. There have been certain concerns on the capital flow side, specifically if I look at the FDI. FDI cumulatively for the year is expected to be even lower than the last year. Of about 28 billion that we clocked the last year. So these are some of the critical issues that come up for consideration if commodity markets, especially oil markets, destabilize.
Saugata, does that therefore mean that one of the key risks that we'll also have to factor in is the competitive populism? 5 state elections and then the big one, and that feeding constantly into more promises that will be fiscally negative.
So difficult to answer that. I mean, there is definitely a risk. There is no doubt about it. To the centre's credit, it has displayed enormous fiscal discipline. It has not succumbed to populist measures beyond a certain point. Of course, the absolute bottom of the pyramid need to be supported through various means that the government is doing. But to a very large extent, the center has not really given into fiscal indiscipline. Particularly, as you know, I mean, you are a votary of this. I mean, the move towards the old pension scheme, which will be fiscally ruinous. So, given all of that, my sense is that for this year, FY24, the government is very, very keen and seems to be committed to maintain the fiscal deficit at the targeted 5.9% of GDP. It is possible that the states announce some other fiscal measures, handouts, which will show up then in FY25, etc. But that's something that remains to be seen. I think that's a political outcome. Let's wait and watch. But the center, to my mind, is very keen on fiscal discipline.
So that's the word from our experts, viewers, and one of the key headlines that I want to leave you with from what I heard from Indranil and Saugata Bhattacharya is that the second half is going to be weaker than the first half, and that's what is important to keep in mind after the IMF has revised upwards its forecast, which, as both of them have pointed out, still lower than what the RBI is expecting. A great number, but some clouds of worry and uncertainty continue. Saugata Bhattacharya, Indranil, thank you very much for your time with us today. With that, it's a wrap on this episode of Easynomics. We'll be back with more. Until then, goodbye.